Running a business in India is no small feat, whether it's managing daily cash flows, buying new machinery, or expanding to a new city. You need funds. But here's the big question, where should you turn? Banks, NBFCs, angel networks, family offices. Over 11 crore small businesses and startups are powering India's economy. But the majority still struggle to access timely credit. Why? Today, we crack the code on business loans in India. The how, the where, the how much, and what it really takes to get approved. So let's dig deep. Stick around till the end because we are not just comparing lenders, we are showing you what works for different types of businesses. If you've ever been confused between banks and NBFCs, this will make it crystal clear. And why can we tell you this? Because we've partnered with over 50 banks and NBFCs so that you don't need to reach out to them individually. We will reach out to them on your behalf and help you raise the capital you need for your business. So, step one, how much can you actually borrow? Let's start with what every entrepreneur wants to know first. How much can I actually borrow? The answer depends on two things, who you borrow from and how strong your business profile is. Banks have a significantly higher ceilings in terms of the amount that you can raise, but they are far stricter in terms of their norms. Indian banks typically offer business loans starting all the way from 10 lakh rupees, going all the way up to a few thousand crore. Yes, thousand crores under specialized secured loan programs. Here's a quick breakdown of what you can expect from some of the top Indian banks. SBI offers various schemes under lease rental discounting. Loans can reach up to 500 crore, but this is usually for established businesses with commercial real estate. ICICI Bank unsecured loans go up to 2 crores, but if you offer property as collateral, the limits increase significantly under their loan against property scheme. Axis Bank offers unsecured business loans up to 75 lakh rupees and secured loans up to 5 crore rupees. HDFC Bank business loans range from 50 lakh rupees to 75 lakh rupees unsecured, depending on location and eligibility. IndusInd Bank primarily focuses on digital first lending, offering quick unsecured loans of up to 20 lakh rupees, ideal for service sector SMEs and solopreneurs. In short, if your business is well established, has strong financials, and you can offer collateral, you can access a much larger loan limits with banks. Now let's talk about NBFCs. These lenders are known for faster approval, lower paperwork, and wider embrace of new businesses. You might be thinking, how do the NBFCs offer this kind of funding? NBFCs have other ways of raising funds from other sources, because of which NBFCs are slightly more expensive, and that is why, even though their criteria are a little relaxed, they can still make money because they charge higher interest rates from the customer. And because of that, their lending criteria are slightly more relaxed compared to the banks. Most NBFCs offer loans ranging from 50,000 rupees to 1 crore, and some stretch all the way up to 2 crore for unsecured lending, especially if your digital footprint like GST returns and bank cash flow statement look good. Bajaj Finserv offers loans up to 80 lakh rupees for SMEs with very strong bank statement activity. Tata Capital ranges from 40,000 rupees to all the way to 90 lakh rupees, which is ideal for small traders to mid-sized manufacturers. Lending Cart, which is known for loans of up to 2 CR, often unsecured with minimal paperwork for businesses which are as young as 12 months old. IIFL Finance offers instant loans up to 75 lakhs for working capital or expansion. Poonawalla FinCorp specializes in unsecured loans up to 75 lakh rupees designed for service-led businesses and retailers. Aditya Birla Capital, Muthoot FinCorp, and Red Fort Capital. Each offers customized, tailored loan solutions between 25 lakh rupees to 1 crore rupees, including bill discounting and equipment loans. Now here's the nuance. While bank offers bigger loans, they are slower and more documentation heavy. NBFCs, on the other hand, are faster, more digital, but typically cap out at 50 lakhs to 1 CR unless you qualify for their premium categories, as I already explained earlier. Because the bank NBFCs are more relaxed in terms of the funding criteria and what it takes to deploy the funds, they are slightly more expensive compared to banks, but completely worth it in terms of the speed of the process and how quickly and willingly they are there to support the small businesses and startups. Step number two, what are the typical documents that you would need? So now that you understand how much amount that you need, that you can get, how much amount that you qualify for, the next step is what paperwork would you require to get them to curate you and underwrite you. So whether it's a bank or an NBFC, you will need KYC docs, proof of business, ITR for the last 1 to 2 years at least, and your financials. NBFCs sometimes accept fewer documents, especially if the loan amount is under rupees 10 lakh. But let's get real. Lenders aren't just handing out money. Behind every approval, there is a process called underwriting where they decide whether you're worth the risk or not. Banks and NBFCs underwrite differently. Think of banks as old school professors. They want structure, history, proof, and the perfect grades. They are the people whom your Uncle Sharma, which you know in your neighbor, would be extremely proud of. That's the bank's way of thinking. NBFCs, they are more modern age. They bet on potential, even if your business is young. So the underwriting criteria for banks, as I mentioned, slightly different. Here's what banks look for approval before approving a loan. First point is credit score. Most banks want a minimum CIBIL score of 700 or above. This tells them that you're financially disciplined. Pro tip here, if your score is below 650, your chances drop drastically and it's pretty much zero. Business vintage. Typically, they want your business to be operating for at least 2 to 3 years or more. They want to see that you've survived the tough early phase and you're making steady cash flows month over month with steady bank balance statements coming in every month. Once you have a steady cash flow, they will have far more confidence to take that bet of risk on you. Profitability. Banks prefer consistent profits for at least 2 financial years. Losses in your P&L, that's a huge red flag. Turnover threshold. Most public and private banks have a minimum turnover requirement, which is often around 50 to 60 lakh rupees annually. Collateral for secured loans. If you are looking to buy land, building, equipment, or receivables, banks want an asset they can fall back on. Debt to income ratio. If you're already loaded with EMIs or existing loans, that's a huge red flag. So if you're a stable, profitable business with clean books, banks will love you. And generally businesses, if you are don't resort to creative accounting to kind of save on taxes, banks would be more than generous in terms of lending you money. But what if you're a younger growing company with cash flow but not too much history? So NBFCs come in the picture over here. Here are the underwriting criteria for NBFCs. They are designed for businesses that are agile, growing fast, and may not tick every traditional box. Lower credit score flexibility. Many NBFCs accept scores as low as 650. Some even go lower if your cash flow looks solid. Shorter business vintage. Some NBFCs accept applications from businesses as young as 1 month, 1 year. Cash flow based. Instead of past profits, they may focus on your monthly bank inflows, UPI receipts, or GST returns to judge your ability to repay. Digital footprint. Regular GST filing, online transactions, active bank accounts. This is gold for NBFCs. They use alternative data and they use digital tamper proof data. That is the real source of truth for them before they decide whether they want to actually deploy funds for you or not. Unsecured loans approval. Many NBFCs don't require collateral for loans up to rupees 50 lakh, making them ideal for small businesses, startups, D2C brands, and even SaaS businesses. Now let's look at the turnaround time. We've already gone through how much you can raise from banks and NBFCs. We've covered what are the underwriting criteria for each of these players roughly before they decide how to invest in your business. Now let's look at what's the typical turnaround time. NBFCs can generally give you approvals in less than a week with digital underwriting tools and AI risk profiling. In a nutshell, banks back proven players, NBFCs back momentum. Both have their own role and their own place. You just need to know which game you're playing and which is the right fit for you. Here's a quick tip. If you're not sure you'll pass bank underwriting, don't burn a credit inquiry. Start with an NBFC that offers a soft check or a pre-approved offer. Protecting your credit score is half the battle. At the end of the day, both are trying to reduce risk. You just need to tell your business story in a way that aligns with their lens. That is how you can ensure that you have a much better chance of raising funds not just now, but even in future. Now that I've told you the basics between banks and NBFCs, how much amounts you can raise, how do they underwrite, and what are the other terms and conditions which they follow in terms of documentation, etc. Let's do a thorough comparison between the two so you can proactively decide which one is a better option to raise funds from. Banks have generally have a lower interest rate, but they have more paperwork and longer processing durations. NBFCs, on the other hand, they have faster approvals, they are more flexible, but with slightly higher rates. If you need a large loan, have a strong credit score, and don't mind paperwork, you can go bank. But if you need cash fast and don't have all the documents, NBFCs could be the way to go. Thousands of Indian businesses are unlocking their next chapter with the right funding sources. The key is knowing where you stand and choosing smartly. That is where we help businesses in terms of figuring out what is the right funding source for them. Whether they should opt for banks or they should opt for NBFCs or other equity funding sources, we act as advisors to ensure that they can find the right source and get the best source of capital for them as quickly as possible so they are not distracted away from their business. Getting funded isn't about luck, it's about being prepared, understanding the lender's lens, and applying at the right place at the right time. India's business ecosystem right now is at a very critical juncture. We are at crossroads with upcoming disruptive startups which are completely changing the game and posing significant threat to traditional businesses. But the access to capital has never been easier. So whether you're a traditional business, a SaaS startup, or a manufacturing unit, know this, there's money out there. You just need to ask the right person with the right way, with the right steps, and identify the right lender for your business. So, if you need our help to raise funds for your business within a month, click the link in the pinned comment below, share your details, and we'll be happy to discuss further. You can check out this video link in the left where we go through the entire details of how we can help you, or you can simply submit the link below and we'll be in touch to discuss how we can help you raise money for your business. All the best, take care.